Howard Johnson, welcome to the podcast. How's it going?
Very good. Pleasure to be here. Thank you for having me.
Yeah, thank you. Look, I came across you first at FEI, Finance Executives International, doing a talk and an M&A update, and I thought, wow, you just cut right to it, provide really valuable, guidance, and you've been through and you've seen it, and I just thought it would be really great to have you on the podcast here and talk about, what you're seeing in the market, and a lot of chatter about M&A and expectations, and would be great to just kind of, get your insights. But maybe first off, how'd you get into this world? What's the backstory, Howard, on, how you got to where you are?
Yeah, so currently I'm a managing director and head of Canadian M&A at Kroll Corporate Finance in Toronto. Kroll is a global financial advisory firm, about 6,000 people around the world, about a $2 billion business. And I think the distinguishing factor of Kroll is that we work seamlessly with our colleagues throughout the U.S., Europe, Asia, and so on. And it really helps to bring a global perspective to merger and acquisition activity, which is important today because you never know where a buyer may be coming from. Previous to this, I had my own firm for many years, Vericap Corporate Finance, and its sister firm, Campbell Valuation Partners, that I acquired back in 2004. And I had worked there for many, many years after the standard stint in the accounting world with KPMG and a few years in industry, including Frito-Lay and an equipment manufacturer. So I've been around for a while anyway.
All right. And I guess, just stepping back, if you think about like M&A and how the landscape has changed, has it changed a whole lot? Or would you say, more of the same, different trends here and there, different flavors? Like what has changed more broadly? I guess lower mid-market, is that a newer evolution in the types of companies that people are looking to acquire? But yeah, what's changed?
No, so look, the M&A market is always in a state of flux. Yeah. So, if you look past the number of years, things were going great. COVID hit, it comes to a screeching halt. Then after COVID, in 2021, if you were an investment banker in 2021 and didn't have a tremendous year, you were in the wrong field of business because nothing could go wrong. Then 2022 comes along, interest rates start going up, things start to slow down. Some moderation in 2023. 2024 takes off again, and of course, here we are in 2025, where it's really a tale of various economies. So my colleagues in the U.S. are seeing a lot of buoyancy. Whereas north of the border, we're seeing a lot of hesitancy as a result of the tariffs as we sit here in early March, and they've just been imposed, and who knows what impact they'll have or how long. But those are the dynamics that you always have. There's always changes. There's always fluctuation. And so that's just naturally the M&A market around the world.
So are they not fretting tariffs south of the border? Is it like...
They don't currently seem to be. I think that maybe certain sectors are, but from what I've seen, they're not thinking much of it. And who knows if our American friends are going to be right or proven wrong. Only time will tell. Obviously, we here in Canada are very concerned about the impact of tariffs on the M&A market and more broadly on our economy. But in that regard, there's a whole bunch of considerations in the M&A market to be taken into account. If we do have a sudden plummet in the Canadian dollar from these tariffs, you may see a lot of opportunistic acquisitions. You may see in the near term many companies that are struggling under bank debt that they can't satisfy the covenants for as a result of their U.S. exposure. And so there may be a number of distressed deals. So I think that the M&A market will still be buoyant. It just may change flavors in terms of what some of the hot sectors are and the reasons underlying that.
Yeah, interesting. Yeah, I mean, in there I'm hearing sort of opportunistic, like opportunities that can come out of a challenging situation here, depending on what side of the equation you're on. So you mentioned sectors. What industries are you focused on, or is it agnostic? And where do you tend to see more attention?
Yeah, I'm an old economy guy. So I do a lot of work in food and beverage, building products, staffing, distribution, other areas where cash flow is the prominent valuation feature. Fortunately, I have colleagues that are specialized in tech, in healthcare, in oil and gas, and in other specialty sectors where if I come across those types of opportunities, they're just a phone call away. So it's very nice to be part of a seamless global firm. We are seeing an abundance of activity across numerous sectors. Certainly, the technology sector is coming back strong as it had a couple of years of softness. But more broadly than that, industrials are coming back. Even the mining sector is getting some life breathed into it. So I think that overall, you're going to see a fairly broad-based M&A market in 2025, subject to what happens with the tariffs and the economy in general.
So when you talk about those industries picking up, and that can mean a lot of things. Like businesses are doing well. The industry, money's going into that space. Financing is maybe opening up and getting easier access to capital. Um, on the flip side, we talked about M&A could be driven by weakness and buying opportunities. Just maybe help me reconcile that when you talk about these industries that are turning around and seeing positive momentum, and how M&A is then sort of driven from that.
Yeah. So you have a number of industries that are doing fairly well. So up till recently, exporters were obviously doing fairly well, and now they're, many of them are going to struggle as a result of the tariffs. Those that struggle considerably may need to find a white knight, and I think that will be both in the private market as well as some of the public market players in Canada. We have many publicly traded companies in Canada, many of which are small cap and micro cap businesses that are ripe for a takeover. Certainly areas that are more directly in the crosshairs of the tariffs, like the steel industry, like automotive, like pulp and paper, are going to find themselves not in a good position to sell right now. But there's other businesses that, more on the services side, that don't have as much direct exposure, that I think could do very, very well in Canada. And as a result of that, we'll still see those multiples being sustained, certainly in the near term, absent the impact of a broader recession.
When we think about the outlook, maybe independent of tariffs, which is sort of very here and now in the present, but just 2025 and beyond, and then even more further out in terms of just the number of companies that are going to change hands. That's talked about quite a bit. Give a little bit of perspective of what we should expect in the near to mid future.
Yeah. Well, assuming that these tariffs get resolved quickly, and hopefully they do, I think you're in for a very buoyant M&A market in 2025 and beyond. And the key reason for that is the amount of capital that's sitting on the sidelines. Both financial investors and corporate acquirers are sitting on capital that is at historic highs. And that money needs to be put to work. It's no good sitting in a bank account somewhere. So there's a real compulsion to buy on behalf of both financial investors as well as strategic investors. On the sell side, we all know that there's many business owners, particularly in Canada, that are coming to an age where they need to do something, and they need that succession plan. Unfortunately, many of these business owners aren't ready for that succession plan, or their expectations are inconsistent with market dynamics. And by that, I mean there's many small and medium-sized businesses that, by and large, are difficult to sell, particularly in cases where the business owner, who's been very much involved in their business and is so enshrined in their business, they become what I call a stockholder. They're stuck in that business. Nobody wants that business unless they stick around, and it can become problematic for someone who wants to leave and retire.
Stockholder, I like that one. What are you telling these businesses that may or may not be thinking about selling right now? But what are some of the things they should think about, year out, 5 years out, as they approach the potential sale?
Yeah. Well, You should always be thinking about how a buyer is going to view your business. Buyers, for the most part, are more interested in the intangible aspects of a business rather than the tangibles. So, machinery, equipment, and so on, that can be replaced, that can be purchased. The question for business owners is, what are they doing to build intangible value in their business? And that usually comes down to the product and service offerings, the people that are there, both management and employees, and the customer base. So those are the things that really attract most buyers. If you have a stable base of diverse customers, if you have a strong management team in succession, if you have strong brand names or something else proprietary for your services that make them sticky and unique, you are a business that is going to be much more attractive to prospective buyers because they can't readily replace those things. On the other hand, if you're a Me Too commodity business, have no good succession plan, have a lot of customer concentration, any buyer is going to perceive that as significant risk and either discount the price they'll pay for the business or not proceed with the transaction at all.
So that's kind of brings me to another question that I just want to sort of validate. I tend to tell business owners a lot of times, whether they're thinking about selling or not, many of the things you're going to do in preparation for a sale, even years out, would be smart things to do in your business. Is that fair to say? Because when you say customer concentration risk, and that's something that a buyer will discount or not want to be involved with, well, that risk is probably not good for a business, whether they're selling or not. So how much of that is true? In other words, the same things that you would do to drive the best outcome on a sale would just be smart business.
Yeah, well, it's absolutely true, David. And if you have a well-run business, so a lot of business owners fail to document policies and procedures. They fail to take other initiatives that are just normal day-to-day bread and butter things because it's all in their head. A business owner should be in a position where he or she could just leave their business and it operates fine without them. And that requires months or years of preparation and work. So that requires that strong management team, the diverse customer base, the strong product offerings, and and other elements that ultimately make a business more valuable. Because when it comes time to sell a business, ideally, the business owner should be in a position where they can sell if it makes sense, but they don't have to sell. And you always want the default position to be, well, I can just remove myself from the business, place a management team in there, and sit back and enjoy some dividends over the next few years. So think of that as the threshold. The stronger that threshold, then the better position somebody is in when it comes to negotiating a deal, because you're not going to negotiate a deal where you're worse off than just sitting back and collecting dividends with a third-party manager. So whatever you can do to enhance the value of a business intrinsically will ultimately benefit a business owner when they come to sell that business to either a strategic buyer or a financial investor.
Right. So, if you're approaching retirement or wanting to step away from the business, but you actually present, you have optionality. In other words, you could sell it or you could step away and have other managers take it on. You have leverage in discussing with potential buyers because you're not in a desperate situation for one, but then they're also looking at your business to say they can acquire it and it's more attractive because they don't need you. And so when they take on ownership, they can assume they're going to have a recurring performance, if not greater. And so maybe that ties to valuation, and maybe talk a little bit about the nuts and bolts of valuation and how you think about that. But, I guess it starts with them looking at what does a business look like when we take it on and goes from there. So how do you approach that?
Yeah, so there's a lot of moving parts to any valuation, and value from a fair market value perspective and the price that a business gets in the market can be vastly different. As a practical matter, you never know what price ultimately a business might fetch until you start negotiating with prospective buyers, because it is beauty in the eye of the beholder. And it's a part of the sale process. The more friction you get among buyers, obviously the better the negotiating position. Like selling a house, if you get a bidding war going, you'll get more than if you have one buyer. But you do want to be in that strong position. You can't negotiate unless you can say no. And to be able to say no, you have to have a good business. So on the valuation side, there's two fundamental elements to valuation. And that is, on one hand, the cash flow that a business can generate, and on the other hand, the multiple or rate of return that is applied against that cash flow. So think of it as the cash flow is the steak and the multiple is the sizzle. So the cash flow would be a normalized cash flow. So it would look at what this business can generate year in, year out on a standalone basis. So typically a buyer will look at it and say, if I had to replace that business owner with a good seasoned manager, what would I pay that person? And that's a burden on cash flow. If there's any discretionary or unusual items, those can be added back to cash flow. So adjusted EBITDA, so earnings before interest, taxes, depreciation, amortization, tends to be a benchmark by which merger and acquisitions are conducted. Now, EBITDA is not a great measure of value because it ignores the realities that businesses need capital spending and there's taxation and working capital, but it is a popular metric and it does win the popularity contest. So it's something that business owners should be attuned to because it's going to be front and center in the sale. What business owners can do beforehand to enhance that EBITDA is to ensure that the business is as clean as possible. So there's something known as a quality of earnings. And the quality of earnings is the difference between the EBITDA as reported, which may be skewed from discretionary items, unusual items, hockey tickets and family trips and all things that sometimes business owners put through their business, and the adjusted EBITDA. The closer those two are, the better the quality of earnings. So business owners are well advised to ensure that there's always a tax consideration. People like to put things through their personal business, but to the extent that they can stop doing that in the year or two before sale and demonstrate that the business doesn't need those items to operate, that can be helpful. The other side is the valuation multiple. And the valuation multiple is the inverse of a rate of return. So by way of example, a 5 times multiple is a 20% rate of return, 1 divided by 5. The multiple is always subject to negotiation, and that's driven by numerous factors. It's driven by the industry dynamics. So capital-intensive industries, for example, sell for lower multiples because part of that EBITDA, that's before depreciation and therefore before capital spending, has to be put back in the business. But the other elements that are driving EBITDA, that higher multiple, are the things that I mentioned before. So a diverse base of repeat customers, strong brand names or proprietary products or services, a good management team. These things help to accelerate the EBITDA multiple. So you're working for both strong cash flow and a strong multiple to get a strong value for the business. And just to finish, there's one other item that business owners forget about, and that's the balance sheet. So everybody is very focused on the income statement, sales and profits and so on, but the balance sheet can be a key element in any transaction, because at the closing date of a transaction, the buyer and seller need to agree on a normalized level of working capital. So the amount of receivables and inventories less payables that should be in the business at the closing date associated with a certain price that's offered for the business. So business owners don't get their working capital in addition to the price. They have to give up a portion of the working capital or normal working capital to justify a certain price. And that working capital peg, as it's often called, is always the subject of negotiation. And from a buyer's perspective, they want that peg to be higher because it means that for a certain price, they're buying more tangible assets, which are less risky, receivables, inventories, and so on. But the smart business owner is going to work to ensure that they manage their receivables, they manage their inventories so that the peg can be lower. They've demonstrated they can operate this business with receivables that are only 30 days outstanding instead of 90 days. And that extra money can be taken out of the business before they sell, and it means that there's more intangible value in the business. Intangible value is the metric by which business owners should be assessing how well they've done. Because everything else, the tangible, everything on the balance sheet, yes, it may be very nice looking equipment and machinery and very shiny and nice, but ultimately that's just an investment into the business. And when that money gets paid back, it's like somebody getting back an interest-free loan to the business. It's nice to get your money back, but there's no extra value. Intangible value is the key to shareholder value creation.
There's a lot there that's super valuable. Okay, but at the outset there, EBITDA is not the best standard, but it is the standard. That's what I'm hearing. Industries may indicate a range of an EBITDA multiple, but then within that range, there are a lot of other factors that will come into play as far as the specifics around that business. And then, so I like that steak and the sizzle. So we've got the EBITDA, you normalize, then look at the, multiple, the sizzle, and then the balance sheet comes into play. And so beyond the working capital, there's also like other things on that balance sheet, right? Like liabilities, or could there be like unrecorded liabilities? How do you kind of navigate that unknown when you start to get into, what don't we know? That's not maybe showing up on the P&L or balance sheet.
Yeah. So in any transaction, there are going to be representations and warranties and probably a holdback or representation and warranty insurance, because the buyer does not want to assume any liabilities that were incurred prior to the closing of the transaction. So the seller is always responsible for any liabilities incurred up to the closing date. So business owners are well advised to ensure that they have good accounting and internal control systems in order to fully report and be fully cognizant of those liabilities, and to reduce the risk that hidden liabilities will only come to light after closing, for which the buyer will turn back to the seller and say, hey, you're still responsible, which can be a very nasty call to get. So any liabilities, be they long-term debt to a bank, or be they payables or taxes that are owing, it always falls onto the seller up to the date of closing.
So on that note, and you mentioned quality of earnings, I guess Q of E is the acronym. Should sellers be getting Q of E's done themselves leading up to a sale? And do you get a lot of pushback on sellers, taking the time and the investment, to get things in order, like the books? And what do you tell those that maybe resist kind of having everything, ready? Because my sense is, a buyer coming in and finding one or two kind of problems or restatements or concerns, they're going to assume there to be more and maybe discount you more heavily. Is that true?
Well, it certainly can be. A buyer for a mid-sized business, and call that a business that has a value $25 million or higher, will likely do a quality of earnings analysis, especially financial buyers, but increasingly corporate acquirers as well. And these are typically done by a firm like ours or an accounting firm and so on, where think of the quality of earnings report as an audit on steroids. They go through so much detail and so much rigor, not just on an annual basis, but on a month-by-month basis, usually for the past 24 months or so. So it's a very big undertaking. With respect to whether sellers should be doing this beforehand, preemptively, many sellers choose to do so. There's a cost to it, but it oftentimes helps to identify issues that should be addressed up front as opposed to over time. So it's not a right or wrong situation, sometimes a matter of preference, and it's very much fact specific. But you're quite right that if the preparation for a sale is more than just the customers and the intangibles and so on, those tend to be the tougher things, quite frankly, because they take years to build up. A good customer base, a good management team, and so on. The other element is, the books and records, the minute book up to date, a good financial reporting system, because make no mistake about it, during any due diligence process, a buyer is going to ask for the seller to dissect information on numerous bases and looking at profitability by customer, by product, by other parameters. And if the seller's information systems aren't able to do that, they're going to find themselves at a disadvantage, and it's going to have a perception in the buyer of higher risk, and that perception of higher risk can lead to a lower price or less favorable terms. So preparation in terms of financial preparation before a sale is absolutely fundamental and key for any business owner.
And I almost come back to that same view on, act as if you're going to sell, and you'll probably do the same things because they're going to create value for your business, even if you're not planning to sell. And I think similarly, having some of those foundational, process controls and reporting capabilities that you're talking about, that you'd want to have in place before you execute on a sale, it just seems to be that would be smart business altogether. The right KPIs, the right views on performance in your business. Sometimes banks are asking, owner managed businesses for reporting that they're not getting, and will come to us and say, hey, we need some help. They need a controller or CFO to get the bank the reporting. And I'll always tell those clients, it's not for the bank. How do you use this to enable the business? And then reporting to the bank is just a byproduct of that. That'll be easy for you. Do you view that the same way, that these are just things that are best practice for businesses and will drive performance regardless?
Absolutely. So, a good management information system can lead to better decision making. When you're looking at which product should I sell, what pricing strategy should I have, should I add an extra shift, all of these major decisions have implications that a lot of business owners just go with their gut feel and believe that they don't need these sophisticated systems, but a buyer is certainly going to look for them. And as a practical matter, business owners should always be challenging themselves. I've done it this way all the time. Am I doing it right? And a good information system would help the business owner to establish, yes, I have been doing it all right, or maybe there's other variables I should be looking at. Breaking down costs between variable and fixed and no step cost, and the revenue elements, by customer, by product. And there's a whole bunch of information that can be gleaned through a dynamic reporting system that can help business owners make better decisions. And it's that old adage of what gets measured gets managed. So having those KPIs, having the right system. And the other key thing with a good reporting system is it's not just in the business owner's head. He or she can better communicate and convey that to their management team and their employees. They can therefore create an incentive system that creates and rewards behavior that is consistent with hitting key variables that ultimately will improve a company's profitability and its valuation.
Yep, fantastic. Would love to maybe hear from you. You've seen a lot. I'm sure, the good, the bad, and the ugly, and you've got some stories, some of which you probably can't or won't share. But what are some memorable experiences, or just to illustrate a little bit of what you've seen, in your time?
Yeah. Well, one came to mind recently. After, of course, COVID was a period of a lot of disruption, supply chain disruption. And I was working with one food company that was really hit hard by some input costs. And given a lot of all their products were sold to retailers, some private label and some branded, they had a tough time in quickly increasing their selling prices. And this put the company into a financial challenge. And at first we had to look for perhaps some private credit or alternate means of credit in order to ensure that the company could weather the storm. And ultimately this led to a sale process. And as we were going through the sale process, the price increases started to take effect with retailers. And lo and behold, some of the input costs started to go back down to more normal levels. So month after month, we saw greater and greater profitability. And the key element there was to demonstrate that this profitability wasn't just short-lived, but to take that recent month or 2 or 3 months and to be able to extrapolate that over a full year and to get full value for something that was a recent trend. And ultimately that came down to negotiation and a good internal management system that could demonstrate to the buyer that this was a sustainable trend and allow them the justification to pay the higher price that ultimately was demanded by the seller.
Yeah, yeah, interesting. Would you say, just as a, how would you guide a business that's run into a real challenge, and maybe they want out, and they are, you know, wanting to get themselves away from the business? There's still some value there, but they just can't manage it anymore, and they come to you and say, like, help me get rid of this thing. How often do you kind of push back to say, hey, like, what can we do before we go down that path, right? Because there's sort of, steps that we can take to significantly enhance your value to get out of this place of weakness. Or how often do you steer them one way or the other and say, okay, yeah, let's let's offload this?
Yeah, well, ultimately it comes down to having alternatives. And we've had situations, unfortunately, where somebody's had to offload it because of health issues. You do what you can for the business owner, but it's a limit to what can be done. The ideal situation is to ensure that the business is a good, strong business years before you go to market. So if there is a development like health or loss of interest or a financial challenge, you still have a strong business that is attractive to a would-be buyer. There are certain things that can be done in the near term. I mean, it's difficult to go out and find a whole bunch of new customers, for example, or launch a bunch of new products if those haven't been in the works for some time. But sometimes the management team that can be improved in the short order. There are many senior executives out there that can be brought in on a temporary or full-time basis to help to stabilize the business and to turn it right. Sometimes there are short-term operational measures, like the sale of some excess assets that can help to steady a balance sheet that's become over leveraged. So each case is fact specific, but there's oftentimes at least a few things that can be done, because you never want to be in a position where your back is against the wall and you can't say no to an offer. You have to have at least some wiggle room in order to get a meaningful valuation for your business.
Would you say there's a split that you can convey as far as buyers? Is it strategic versus financial? And I presume it shifts over time. You mentioned more strategics coming to the market as of late. I think you said that. But just talk about where buyers come from. And I know it's industry specific as well. But can you give a little bit of color on that?
Both financial buyers and strategic buyers have been out there for some time. Financial buyers are actually the ones that are coming back to the market very rapidly, because they're driven more by the ability to use lower cost debt financing. And as we've seen, the cost of debt decline and the accessibility to debt decline. So that's why in 2021, there was so much buoyancy among financial buyers, because interest rates were near zero and debt was easy to get. So they lever up the balance sheet as part of their investment thesis. But corporate buyers are also out there, and corporate buyers, especially public companies, have a challenge, because if they have a lot of cash on the books, the shareholders will say either spend it or give it back. Well, the CFO of a public company doesn't want to give it back to the shareholders, so they're always looking for accretive acquisitions. And so there is an internal need to consummate acquisitions in order to make the market happy and make shareholders happy that there's continued growth beyond just the organic growth. So I think you're going to see both financial investors and strategic buyers very active in the market over the coming years, because both have a lot of capital that's available to be readily deployed.
And so when you mentioned like the capital, the dry powder that's been there for over the last couple of years in a high rate environment for like private equity, but was the cost of debt the big rate limiter in the sense that they could deploy equity, but they also got a significant amount of debt, and so that was holding them back from
That was holding back a number of financial buyers, especially through late 2022 and early 2023, where interest rates were going up. And it was not just the cost of debt, but the accessibility to debt. Right now, the private credit market is actually something that's also come to the forefront in terms of another avenue to get lower cost debt to finance transactions. So most financial buyers look at three elements when they're looking at a potential transaction. They look at leverage, so the amount of debt that they can put on the balance sheet rather than their own equity. They look at growth, both organically and through acquisition. And they look at what's called the exit multiple expansion, meaning that they buy a business for 6 times EBITDA. They can sell it for 8 times because they make it bigger and better during the course of their holding period. But remember, a lot of these financial investors are set up on a fund life basis, meaning that they raise a fund that's usually about 7 years. Within that time period, they have to get the money in, invest it, grow the business, and sell. So those funds that were raised around 2022, before all these interest rates started going up, if somebody took a pause for 24 months, that clock is ticking. And in order to raise that next fund, they have to show results in this existing fund. So that's why a lot of these financial investors are aggressively looking for investment opportunities, because giving the money back to their limited partners is not going to bode well for them. They've got to invest it. They've got to make it grow.
Exactly. And that's a great segue maybe to CFOs. You mentioned how a CFO of a public company would think. And I'd say, like, in that environment where there's more urgency to that exit to execute, I think we see a lot of private equity firms looking to CFOs and that controller to CFO level to help in their portcos. I would love your perspective on CFOs and M&A, and how you've seen their involvement either change or just how they're adding value to the process today, before, during, or after close of a transaction.
Well, as a sell-side investment banker, there's nothing more that makes you happier than to see a strong CFO in place inside of a company, because that individual, unfortunately, is going to get a lot of the burden of the sale transaction process. I mean, he or she still has the day job of keeping the books and records and making decisions, but they also have the responsibility of information gathering, attending management meetings, and make no mistake about it, when it comes time to paper a deal and there are dozens of schedules, detailed schedules to be prepared, it's the poor CFO or their accounting team that needs to do all of this heavy lifting. So they really need to be well organized and incentivized, quite frankly, in order to help the business owner to realize that big monetary transaction at the end of the rainbow. And a weak CFO will oftentimes be very detrimental to the business owner, and they won't realize it until they're partway through the process. Things start falling apart, and ultimately it could cause a deal to collapse if they don't have a strong CFO in place.
Would you say that's quite common to see the weakness at the CFO level, if not a non-exist? Like, somebody could be called a CFO, but they're just not truly operating at the CFO level. How common is that?
It's not uncommon, I would say. What happens at a lot of mid-sized businesses is that the CFO role outgrows the individual. So maybe they join the company as more of an accountant and the bookkeeper, and for years they grew with the business, and they're very good with respect to bookkeeping and keeping the debits and credits, particularly where the business has been flourishing and there's been really no need to work with bankers and so on, and the business owner's been involved, makes all the tough decisions. And that CFO is really a scorekeeper, an important function, but very different than the strategic CFO that's needed in order to help facilitate a transaction. So we see in some cases, the CFO or a new or interim CFO is brought in by the business owner specifically for the purpose of assisting with a transaction, so that the existing CFO can focus on the day-to-days, which are very important, especially through a transaction process. But the incremental cost of having somebody there is well worth it, because it allows that person to focus on getting a deal done rather than being distracted with their day job. And they're oftentimes an individual who's gone through this process before. Maybe it's a CFO who's been displaced as a result of another merger. So they've seen the process internally. They've gone through it. They know where some of the pitfalls are, and that makes them a valuable resource to the business owner.
Yeah, in fairness to the incumbent, it may not just be like sort of competency. They have a day job, to your point, and so
Yeah, absolutely.
suddenly having this, M&A, this big sale upon them, the day job doesn't go away, and so yeah, sort of like a dual kind of rationale to think about that interim CFO that can kind of alleviate their constraints and bring the prior experience to make it a lot more efficient. So yeah, I'm a big proponent of that. And I guess that ties to fractional and interim, the world that I've been spending a lot of time in over the past few years. How have you seen that evolve in the circles that you're in? A lot of fractional and interim work. Has that changed over the years?
Yes, it's certainly fractional and interim CFOs have really become much more common today than they were even just a few years ago. And I think there's a number of reasons for that. I mean, many unfortunately found themselves good CFOs that were displaced from a merger or acquisition or something of that sort. Unfortunately, it is oftentimes the CFO that gets displaced when a bigger company takes over a smaller business, and they find that they can bring their expertise and their knowledge to the marketplace. So this is where we found interim CFOs or fractional CFOs to be very helpful, because if a business owner is getting ready for sale, they may be well advised to consider that fractional CFO to come in, help make sure that the financial accounting system is in good shape, help to gather all the information. If there's a quality of earnings, be that point person for all the information so that the incumbent can make sure that the day job is done. There's nothing worse than the company starting to show cracks during a sale process. So it's important to have the incumbent focused on their day-to-day job. That interim CFO can come in, help where they're needed, make sure that it's a smooth process, and transition out easily as part of the transaction. So it can be a very, very great resource for business owners.
Yeah, that's helpful perspective. Yeah, what have we not touched on that you think is really important to convey as it relates to the M&A process for businesses?
A lot of business owners ask me, well, what could possibly go wrong?
Yeah.
And it's always those horror stories. So I put the process down into eight components. So the first is the timing of the sale, and obviously the timing of the sale, you've got to give yourself enough runway, and think of it as if a business owner wants to be on a beach sipping their umbrella drink at age 65, they really have to start thinking of the process at age 60, because it takes a good year or more to get ready. It takes time to go out to market, and the business owner may have to stick around with the business for a year or two afterwards. So it can be a 5-year journey. It doesn't have to be, and it's not every day, but they should really think about it years in advance. The other thing, then they have to get the business ready for sale. They have to remember that they have one chance to make a good first impression. So it's the accounting system, it's the balance sheet, it's tax structuring. There are 3 parties to every transaction: the buyer, the seller, and the government. And there's a lot of things that business owners can do to legitimately reduce or defer the government's take. And if they don't, and they pay more taxes, they don't even get a thank you card. Then there's a valuation piece. And many business owners have an inflated view of what their business is worth. So getting a good, credible, independent valuation or independent valuation advice before they sell becomes important, so they don't just dismiss a fair offer, or they better understand how to make their business better. Then when they go to market, I like to go to market, and I like to count the number of serious qualified buyers on one hand, but not one finger. So they mismanage the process. And they have to recognize that as they go to market and they search for buyers, a lot of people gravitate toward that competitor. Well, the competitor usually isn't the best buyer. The best buyer tends to be a platform buyer. A platform buyer is somebody that looks at the business and say, hey, if I had your customers, your people, your products and services, again, those intangible elements, they could take it to the next level. They're more revenue focused.
And that could be a financial or strategic, right?
Financial or strategic,
yeah.
Absolutely.
Yeah.
Absolutely. And then conveying information. There's a lot of information that people want to show about their business, but they've got to remember it's a two-way street. You want to learn as much about the buyer. Why do they want to transact? What's in it for them? Because it's going to come down to negotiating. And negotiating that LOI, the letter of intent, is absolute key pivot point. While the letter of intent is non-binding, it should set out all the key commercial terms for a transaction. And anything that's not in a letter of intent or is ambiguous is subject to negotiation after exclusivity. And exclusivity is a pivot point in every single transaction. Sellers should be reluctant to give it up until they feel that they've got the best deal possible, because their risk and their exposure is between the letter of intent signing and closing the transaction. And it's not just the price, it's also the deal terms. The deal terms are just as important as the headline price. So cash is always nice, but there could be promissory notes, share exchanges, earnouts, other mechanisms. Any dollar not received at the closing of a transaction is a dollar at risk to the seller. So they have to be satisfied prospective reward is worth the risk. And finally, getting that transaction closed, it's got to be business as usual. It's got to be all hands on deck. It's got to be ensuring that customers are happy, production is running well, and this is where that interim CFO becomes instrumental, because they can do some of the heavy lifting while everybody else is focused on running the day-to-day so that the deal goes through and gets signed.
Fantastic. How much is communication a big part of all of that? So, like, depending on the business, but I'm sure a lot of owners keep this close to their, vest, and then obviously bringing in CFO. But how much is communication throughout end to end a critical part of how you advise and guide?
Yeah. So every business owner wants confidentiality, and that's always key. And while there are non-disclosure agreements and other protocols that can be followed, there's never a guarantee of confidentiality. It's unusual that there's a leak, and a business owner has to be ready with the messaging in the event of a leak. That can be as simple as saying, look, we're always getting approached by prospective buyers because we're a good business. And so there can be ways to work around and manage potential leaks. But usually there is a subset of employees that are brought into the fold, because the business owner can't do this on their own. Because the buyer is going to look across the table at the business owner and say, if I'm buying your company and I put tens of millions of dollars in your pocket, who's going to run this business? And that's why the business owner is well advised to have a strong management team, in sales and marketing, and in operations and finance, other key variables, because in an ideal world at that management presentation, when the business owner is presenting to the seller, or to the prospective buyer rather, the business owner can stand up and say, look, I formed this business 30 years ago with $1,000 in my pocket and stars in my eyes, worked hard for the past 20 years, and then for the past 10 years, I've been mainly vacationing and going play golf, and Joe and Fred and Mary have taken over, and they're the day-to-day people, and I'm just a bother, so I'm not even going to talk anymore. And the management team walks in. That's a great situation. That's a great situation for both the buyer and the seller. But the seller has to also think about incentivizing those individuals, not just to get a deal closed, but maybe even a pay-to-stay bonus. And yes, it's a cost to the seller, but losing good people could mean that there's no deal or not an attractive deal without those individuals. So there's always give and take in any transaction.
Bottom line, there's a lot to think about and a lot to do. And so,
yes, there is.
And those steps, there's a pretty clear line to ROI on so many of these activities. You can literally draw a line to that multiple, and that even enhancing EBITDA in your business on a recurring basis, whatever investment in that return, you have to look at the multiple of that return to say that's the value back, the ROI. So all of these things that companies can do leading up to a sale, or the things not to do, have a huge impact. So I'd recommend they get in touch with you, Howard.
Well, I appreciate that. Thank you, David.
So thank you so much for taking the time. Really, really appreciate this, and hope you'll do it again sometime.
Yeah, absolutely, and my pleasure. One thing that I will mention, and you can pass on to your listeners, is I've written a lot of books on mergers and acquisitions over the past 20 odd years, and I do sell them on a separate website. That's strat-plan.ca. I'll send that to you, but they're available for purchase, buying businesses, selling businesses, or whatever And oftentimes business owners find it helpful to get that education, to know what to expect as part of the journey that they go on.
Yeah, thanks for sharing. Fantastic, and we'll add that to show notes when we put out the episode. So yeah, very much appreciated. Thanks a lot, Howard.
Thank you again, David.